Hi, my name is Jim and I was retired. I'm going to share a short video this week about I bonds to counter an article I read yesterday. The gist of the article was that if you waited to buy an I bond in November, you will earn more than those suckers who bought in October. I'm here to tell you that it never pays to procrastinate. Stay tuned and I'll explain how I bonds really work. Now, this is the article where Brian J. O'Connor writes, "It pays to procrastinate. The new 6.89% I bond will beat the old 9.62 bond in just 4 years." Where's the math? That's not correct. I was among the hordes who purchased I bonds, according to this article, collecting historic high interest rate of 9.62% before the rate was lowered in November. I purchased in October and in September and earlier in the year too. See my I bond playlist for buying more than $10,000 per tax ID through gifting. Brian then says I should have waited. Those who picked up I bonds yielding 6.89% in the latest auction, I bonds are not sold by auction, by the way, will find themselves making more money in a few years than those who rush to grab the old higher rate. How is that possible? That's what I want to know too. He then explains that an I bond has both fixed rate and an inflation factor. The bond bought in October had a fixed rate of 0 and an inflation factor of 9.62%. And it's guaranteed only for the first 6 months that the investor holds the bond. So far, he's right. But then he says the rate will be heading down while the rate on the November 2022 bond will be steadily staying up. What? Well, that's because he says the new bonds are being issued with a base rate, or fixed rate as we call them, of 0.4% and the new inflation factor of 6.49%. It's actually an inflation factor of 2 times 3.24%, or 6.48. You get to the 6.89 through the formula, which is a little bit more complex than just simply adding the fixed rate to the inflation factor. He points out that the October bond will have a fixed rate of 0, whereas the November bond has a fixed rate of 0.4% for the life of the 30-year bonds. That's right, but then through some mysterious math, he argues that the November bondholder will be ahead of the October bondholder in about 4 years. Now, this writer is promoting SmartAsset, which will hook you up with a professional financial planner in your area to go through the math. But let's see what he might have done here. I'm going to show that those that bought in October will have several $100s more than those that bought in November if they both hold the I bond for 5 years. And I pushed it out to 5 years so that we get beyond the withholding of interest. If you cash a bond in years 1 through 4, you can't cash it in for the first year, but if you cash it and redeem the bond in years 1 through 4, you will give up 3 months of interest. And that's why Treasury Direct, until you pass that threshold, will always show you a value that is slightly less than what you actually accrued so far. Let's go through the math in the formulas. We'll first show you the person who purchased in October. And again, this is the spreadsheet that I've showed before. Assume a $10,000 purchase, a fixed rate of 0, inflation factor of 4.81, got you to that composite rate of 9.62%. And then the payoff on the interest is really based on this exact formula with a notional $25 for the bonds. So you have to calculate that, the interest on that notional amount, times it out by your bond, and that gets you the I-bond interest for the first month is $80. And so forth through this all the way out to $480 for the first 6 months of interest. After that, this is where the writer gets it wrong next. After we get done 6 months of 9.62, we still get the inflation factor for those November rates on. We get that. It's going to be the 6.48 because there's no fixed rate. The fixed rate is 0. And when you calculate it out, the composite rate is 6.48 for the next 6 months. Then for both bonds, I'm going to assume something that's going to step down. I'm going to step it down first based on some recent readings of inflation. So let's just assume the composite rate comes in at 3.12% for the next 6 months. And then I'm going to say the average inflation factor is 1.23%. So let's just, for the rest of the bond, rather than 0, as Brian did, let's use this average inflation factor in both formulas. And that means for the rest of the 5 years, this October bond purchaser will earn 2.47. And when you see that, it comes all the way down here to, I'm going to say, $2,000 worth of interest for the purchaser in October. November, they're getting the 6.89. I'm going to assume the same inflation factor I used in the other case. In this case, because of the higher fixed rate, they're going to earn 3.53% for the next 6 months. And then they're going to get 2.87% with that same inflation factor in their formula for the rest of the time. And you'll see that I'm going to take them out to December. They will have earned $17.68 in interest. And so you can see that the purchaser in October has earned $2,000 worth of interest by that time we get to November 2027, whereas the purchaser in November will have only earned $1,768 in interest by December. I'm giving them one more month to equal the same 5 years of interest. So I hope this clears up some of the I-bond math for Brian and others that may have thought that procrastinators win. I've always heard that the best time to invest was yesterday. And it is true that the fixed rate over long times will yield more, but it's going to be substantially more than 5 years until you have a break-even point on that. And I'm not keeping the October bonds or the September bonds or the April bonds that I purchased with that 0 fixed rate forever. They fit into my bucket strategy. I'm keeping them for a period of time. Higher fixed rate, and I'll buy in 2023 something with a higher fixed rate to replace some fixed rates of 0.3 that are in my portfolio. So it all depends upon when you need the money and whether it's a good math for you. By the way, I am not a financial planner. You will not be able to connect to me with SmartAsset. So please take these as entertaining ideas from one educated consumer to another. Always do your own due diligence, and see you next time.